So good evening to you all. So I'm going to give you a quick whistle tour. So before I get into the core subject, give you a bit of background. If you don't know my background, so I started a business in recruitment. I kind of fell into it, knew nothing about it. It was almost by accident, and started a business called Mann. Started on my own in a tiny broom cupboard in Pall Mall, and grew that business. From that to today, it is now in 22 countries, employs 8,000 people, and was sold to the Canadian Pension Fund for 1.6 billion. It's number one in the world in terms of a talent solutions company. So I think what's quite useful in that example is it's quite amazing that you can honestly have just a simple idea that you think may never work. But actually, what was unique there, so why did that business do? When I set up Mann, conventional recruitment back in those days, now we're going back 35 years, was a transaction business. So recruitment typically is you call a client, have you got a vacancy, you take the vacancy and you fill the position. My concept was, why don't I go to that client and rather than taking a position myself to say, can I manage your talent solutions? And at the time, nobody had ever done that before because the market was quite linear. And although the idea was very good, most of the clients said to me, I don't understand how you can do that, because when I want accountants, I go to Michael Page. If I want secretarial, I go to Adecco. If I want, C-level, I go to Hydrix. How can you do all of it? Because you cannot be all things to all people. I said, that's a great point. We are absolutely not saying we are all things to all people. What we are saying is we're talent specialists and we can manage that supply chain because we understand this market really well. So if you appoint me, I will sign an agreement with you to manage all of it. I will then go out and buy from the market. So I will use Michael Page, Hayes, and all these different suppliers. By the way, none of which I'd ever spoken to, I just made it up. So I said, I'll buy from the market, I'll do deals with those people, and then we can channel the people in there, but you effectively sign with me. Anyway, I knocked on doors for 11 months and everybody said, piss off, not interested, don't want to give one organization that sort of commitment. But as we know, if you knock on enough doors, if you keep trying, if you keep doing it, somebody somewhere will say yes. And Fujitsu, in month 11, said, actually, we quite like this model. We currently deal with 27 different suppliers. We have 27 different agreements, 27 different payment plans. Having one organization who manages it, actually, we think makes a lot of sense. We'll agree one fee with you. So we don't care what you pay the market, but we have a fixed fee. Anyway, it was a 15 million contract. And I was going to deliver that come hell or high water, because I knew if I got one right, I now have the case study to replicate, and fast forward 30 years, it's now the biggest in the world. And what is quite amazing is even after 35 years, it has no competitor, which is strange. You would think that somebody would have replicated it, but I think the model has become quite complex because pricing. So the last deal they did was last year. They signed up HSBC, and HSBC have signed a 5-year contract where every single employee in Tokyo, New York, London, Frankfurt, Rome, all over the world, every employee will be hired via Mann. Pricing that is quite complicated, and how you deliver that is quite complicated. So I think the reason why the competition hasn't really followed suit is because it's actually quite a complex model. The other factor is most of the clients are kind of Fortune 500 clients, and it is such a big strategic decision for an organization to sign an agreement with somebody who now is responsible for your entire talent. That decision today has to go to the board. And because Mann is number one in the market, people won't take the risk of going to number 2 or number 3. They think it's too strategic as a decision. So we have miraculously every year put our prices up, and we just keep putting them up because there is no other option. So until somebody gets to that position where they are positioned as a credible number 2 or number 3, we dominate the market. And we find that people like Manpower, lots of people have tried, and of course they all go in lower, but the client won't take the risk. So quite an interesting experience there. So that was Alexander Mann. So from there I joined the panel of Dragon's Den. Wasn't planned or strategic, it was completely out of the blue. I got a phone call from one of the researchers on BBC, said we're looking for adding another dragon. What we have currently is Deborah, who does sustainability, Peter, who does technology, Theo does retail. We'd like somebody who backs people, and your kind of background is very people orientated. Would you be interested? I said, I'm a recruitment guy, I'm not a TV guy, I've never done it before. How does it work? What do you do? They said, we film at Pinewood Studios, why don't you come along, do a couple of days, trial, and if you enjoy it, great. If you don't, you'll have a bit of fun. So I'd never been to Pinewood Studios before, so I thought that would be kind of fun. Spend a couple of days there, bump into all these TV stars. And to my shock and horror, when I walked in, I thought, I don't know why, that when you go to the den, that in the morning when you arrive, you'll get a pack where they'll say, these are the 6 entrepreneurs you're going to see, these are the businesses, this are their CVs, this is their business plans. You can at least have a feel. So I arrive and I say to the guy, can I have the pack? He said, there's no pack. I said, so how does it work? He said, you go and sit down. We say 3, 2, 1. The guy walks up the stairs and you give him the money. My money. Just to be clear, it's my money. They said, yeah. I said, not your money, it's my. I said, okay. Anyway, so I tried it. I sat and he walked up the stairs and he's invented this cucumber holder that he values at £800,000 and he wants 10%. And I'm like, really? Anyway, I'm like, these guys cannot be serious. But that's actually how it works. The guy walks up, you get 30 minutes, you've got to make a decision. And it doesn't really matter how wealthy you are, but it's still 100 grand. You know, it's quite a big decision on the back of 30 minutes. And anyway, so I said to Peter Jones, I said, you've been here for ages. How do you do this? He said, you just got to understand, you've got 30 minutes to scrutinize the business, break it down into its component parts, understand the market, understand the model. I said, it actually works. He said, yeah. I said, okay. Anyway, so I did. I was on there for 3 years, backed 14 entrepreneurs, invested 1.6 million, probably lost it all, but that's neither here or there. And the one I did, so a quick story. So I'd been on the show for 3 weeks, hadn't done a deal, was getting dressed on a Friday morning. It was the 3rd week. And my daughter said, you know, how's it going? I said, not great. She said, have you done a deal yet? I said, no. She said, oh my God. She said, all my friends at school, I've told them you're going to do the show. Everybody's really looking forward to it. Dad, please don't be the loser on the show that doesn't do a deal. Anyway, so I'm in the taxi, we're driving, and I think to myself, she's right, I've got to do a deal. So I thought, I'm going to have a plan. I'm going to walk in. First person who walks through the door, I'm just going to put my hand up and say, I'm in. So I sit down, and the first person comes in. It's a lady, her name's Sammy French. She said, hi, Dragons. I've got this great invention. I've been studying this for 2 years. I believe one of the biggest challenges that we have in England today is our dogs are too fat. And I've invented a treadmill for a dog. And I invested 100 grand in that. In my garden, we have 46 treadmills for dogs still. So what did I learn from there? Most of the entrepreneurs that you get in Dragon's Den, I think they think they have an idea and it's a business, but they haven't taken it any further. And as we know, ideas do not build businesses. You can have an idea every second of every day. It doesn't mean it's a business, but they have this light bulb moment. They've had the idea and they cobble up a business plan. And what I tend to do when I was in the den is I kind of would say, okay, let me just assume that this idea works. I'm not even going to challenge the idea because that'll take me an hour and I don't have an hour. So I'm going to give you the benefit of the doubt the idea is good. How are you going to market it? And 9 out of 10 fall over. Because if you can't market the idea, does it really matter how good the idea is? if you haven't worked out how are you going to take it to market, and if the best you're going to offer me is Google AdWords, you're going to go bust because you haven't got that kind of money, because Google AdWords cost a fortune. So route to market in Dragon's Den was probably the biggest lesson I learned, is if they haven't worked that out, the rest of it was irrelevant. I then, having built my recruitment business, and quite an interesting journey, so I sold that to Advent International. Advent International sold it to Graphite Capital. Graphite Capital sold it to New Mountain Capital, and New Mountain Capital sold it to OMERS, the Canadian Pension Fund. So the company went through 4 different buyers. So it's quite interesting how private equity trades with itself. So it's, in a lot of cases, your exit can literally be to 4 different PE firms. And the CEO that I put in place, she did incredibly well, because every time there was an exit, the new private equity firm came in and said, come on the journey with us. We're going to take the business from A to B. And if we achieve the following hurdles, we'll share some of the upside with you. So she made money with me when she had real equity. Then we sold, I left. She stayed on and she got dialed in to the next round, and then the next round. So it's quite incredible to watch that, how she effectively lived through 4 different exits. And each time, so when I exited, it was about 250 million. The last exit, I think, was 1.6 billion. So she actually did incredibly well. So you can be a corporate employee within a firm in that kind of private equity chain. And I think she probably netted about 70 million. So quite a successful story. I then set up, basically took the capital from the business I sold, put it into a wrapper, called the wrapper Hamilton Bradshaw Private Equity. Wasn't really private equity, it was my own money, but had a bit of a wrapper which I could go to market with, attract people and hire a team. So effectively invested in lots of different areas. What was the lesson I learned there? So when I set up that firm, I think most entrepreneurs who have sold a business end up believing in their own hype. You think, because I did that and it did well and I made money, anything I touch turns to gold. Clearly not. So when I set up the firm, my first investment was a chain of gyms. What do I know about gyms? Nothing. Did it work? No. Did I lose all my money? Yes. Why did I lose my money? Because I didn't understand the business. But I'd set up this stall thinking I'll go and invest because I built a successful business, and that will translate to the next one. It did not. I then bought a chain of nursing homes because I thought everybody gets old, everybody needs a nursing home, it's going to last forever, the government's a big spender, all the data reads well, you can make a lot of money. So I invested in that. I lost all of my money because compliance, governance, health and safety, the regulations in that product are unbelievable. The cost of implementing those regulations crucify the margin, and you end up doing it for nothing. So I did that, it didn't work, so I lost my money. I thought I'll have one more go, and I bought a chain of sandwich shops because I thought everybody eats sandwiches every day. The high street is really busy, it's packed, you can't go wrong. And I bought a chain called Benji's, had 126 stores, 600 employees, 75 million turnover. I thought I could make money out of that. Anyway, it went bust. I lost my money there too. And then I realized, why am I not investing in something I understand, which is recruitment? And the reason you don't do that, because you think, I've been there, I've done that, I know that. For some reason, you don't do it. So I then invested in a recruitment business, and surprise, surprise, made 6 times my money, and it went really well. And what did I learn was because I understood it. I understood the business. And to me, when you're investing, the one thing I learned was if anything can go wrong, it generally does. That's for sure. And if it goes wrong, how do you fix it? The problem is, if you cannot understand how to fix it, the chances are you will lose your money. In recruitment, to me, it was like an engine. I knew how to build the engine, which means I knew how to unpick it. I also knew when it didn't work, which nut to turn, which lever to pull to get it back on track. With the sandwich shop, I looked at the engine, it didn't mean anything to me. I didn't even know what I was looking at. So when it did go wrong, it just fell over. So my big lesson there was stick to what you know. And surprise, surprise, in the last 15 years, we've invested in 53 recruitment businesses. We've sold 17 of them. We have a portfolio of 37 because we get it and it works. I think in my kind of next chapter of investing in those businesses, what have I really learned? When we meet somebody who's selling us a recruitment business, most people believe as soon as they've made a profit, they're now ready to sell. So the market entrepreneur believes profit equals exit. What we've realized is that is just one part of the ingredient of the deal. But it's quite incredible how many entrepreneurs believe that I've made a profit, I'm making 2 million, 5 million, 10 million, I can sell. So the number of businesses we see where, because let's say he's made 5 million profit, but because recruitment is professional services, people orientated, generally the founder owns most of the relationships with the clients. So I buy the business, something happens to him, where does that leave me? Nowheresville. Business is gone. So even if he's made 5 million profit, does that mean it's worth 7 times earnings? No. If I buy a business and actually it happens to have NVIDIA as his biggest client that represents 36% of his revenues, am I going to pay 7 times for that? No. Because I'll give you a live example. Cinven bought a business from a friend of mine called Phones for You, and the business had one contract with Vodafone. So Phones for You were distributing phones on behalf of Phones for You. Made 140 million profit, sold for 10 times earnings, so 1.4 billion. John sold the business, and 19 months later, Vodafone cancelled the contract. What happened to Phones for You? Disappeared off the high street. It's called concentration risk. So when we're buying, what we've learned is there are 9 different constituents of value that we look at, that unless that business represents each of those values, we're not going to touch it. Way too risky, way too risky. So let me just take you straight to, so in my PE firm, these are our kind of baseline model. So unless a business represents those factors, we don't look to invest. But what is even more important is the businesses we invest in, we are focusing on building that model, because this is what a buyer will pay for. If those businesses represent these issues, we have a deal. But we found that we've never got lucky. I think we've invested, built, scaled 17 different businesses. We haven't been lucky enough where Father Christmas turned up and paid us 10 times earnings. It hasn't happened yet. Every deal we've done follows the same principle. We meet somebody, we like them, they give us a term sheet, and the next thing is PwC show up. And they're in there for 3 weeks. And what are they doing? They're looking for this. And if they don't find it, they write a very nice report at the end with a bunch of observations which kills the deal. Because the buyer, most buyers are quite sophisticated. Anyone who's going to write you a sensible check generally knows what they're doing, and they'll either have a bunch of advisors, lawyers, whatever, and if those things do not add up, there is no deal. They just walk away. So we learned the hard way at the beginning that where we thought, but it's highly profitable, it's got great this and great that, and all the things that you want to convince yourself that somebody will buy, what we learned is it's not enough. Unless that business has good corporate governance, because most of the deals I've done, I've either sold to overseas buyers, so a company in America that wants to buy a business in the UK, so they're trying to manage the business from a distance. If that business has poor poor corporate governance doesn't work for them. So we've got proper metrics, proper reporting, proper board meetings, management team properly aligned. So corporate governance, we have found that when we demonstrate the quality of our corporate governance to a buyer, it actually makes it very attractive for them. If we say we have had a record year, but the other 3 years behind weren't that great, we don't get good value. You have to show the trend. One good year doesn't, what do they say? One swallow doesn't make a summer. So that consistency of performance underpins value. So we won't exit a business until we can show that growth. So we're quite disciplined in maintaining. And if we have a dip, the problem is once you have a dip and you sell the following year and you've done okay, the buyer will look at that and say, you want 8 times, 9 times, 10 times earnings, but this could dip the next year. So I'm not going to pay you that. So unless you can show the line, you don't get the valuation. So if we do dip, we hold probably for another 24 months because we know we're going to get chipped on the value. On professional services, we are obsessed with management because most firms today do so many different tests on management. They bring in external advisors, they do psychometric testing, they do various different reference checks. There are independent firms that they hire who will come in and spend time with management. Because if the management team doesn't stack up, you won't exit that business because that's what they're backing. And, we just closed the deal 3 weeks ago. We sold it to a firm in the US and they hired an independent firm who came in, spent 2 weeks with the management team doing an assessment, and quite rigorous. I was quite impressed. They did a really good job, but it kind of made me realize it's something we're not doing. So now all of our businesses, we are grooming management in preparation, recognizing that at the point of sale, they are going to go through this and they need to understand it. So as an investor, just preparing the team and making sure that the team has to be aligned with you. Every single deal we do, every management team we have has invested with us. So as a point of principle, we don't invest in businesses where management have not invested with us. So even if we love the deal, we think it's great, wonderful, but they're not aligned, we don't do the deal. Because we find that if we're the only ones making money and they don't make money out of it, it doesn't work. If you're going to go the whole way, you both have to do well. And that doesn't work. All of our experience has shown every time we've taken a management team that doesn't have enough skin in the game, it's quite hard work. So that whole kind of balance, I think income stream, where does the revenue come from? I think having that spread of revenue, having diversification of revenue, ensuring the revenue is not concentrated in any particular area, whether it's product, geography or client, is an issue for us. So we track it monthly. So each business we invest in, part of our metrics every month is analyze where does the revenue come from to avoid that concentration risk, because we know it affects value. So one of our constituents of value is ensuring, and for example, if we have a business that has got an over dependency on fewer customers, we as the PE firm will hire somebody to go in for 12 months and spend time on sales to redistribute the customer base to ensure, because for us, we know that's probably going to lose us 2 percentage points on value. Not worth it. Better to bring somebody in and address the issue. I think in professional services, retention's quite big for us because we know it comes up in the due diligence. So if you've got quite a high churn rate, or if you're not able to retain those people on a consistent basis, it chips away at the value. So we do a lot to make sure that the processes that we use of how we bring people in, how we maintain them, and how we track them, is quite fundamental to our valuation model. I think conversion from revenue to profitability is a metric that all professional services firms are tracked by. So if you're making too much, believe it or not, it goes against you. They think your cost base is out of sync if you're making too much. If you're making too little, you're not running the business very well. So in each sector, it's quite important to know what is the level that you should be trading at in order to get the valuation right. And I was really shocked. About 7, 8 years ago, we had one particular business which was overperforming, and we were converting at something like 47%. I thought I thought we'd get a premium for that. In fact, nobody wanted to buy it. It went the complete opposite, because they said, we don't think it's sustainable, and therefore we're going to run some sensitivities. And we never got any more than I thought we would get, because actually, and I thought they were right, because we were getting, the margins were not sustainable. We were just doing it incredibly well. But if you had to grow that business, I think it would have come down. So actually, you need to understand the sector you're in and what is the market norm for that sector from a income to profitability perspective. Any questions on that before I move on? Quite an important slide.
The question is actually about this alignment of the management incentives with you as an investor. You come to a business where that is owned, let's say, by two entrepreneurs, right? And the management does not have, and it's managed by the professional management team, and the management doesn't have alignment with the business. You said, okay, I can co-invest, I want to buy whatever, 30% or half of the business. Would you tell current owners, so, okay guys, you have to distribute some of your stake to the management before we come in, or you would come to the business, you would buy half of that, and then you would align management incentives?
We'd never do the deal. We would have to have that resolved before we enter, because once we're in, it's too late. Because if it doesn't work, then probably going to lose our money. So we would need to understand what is the position of management before we sign the agreement, and how aligned are we with them? Because typically what happens is, emotionally, when the business does really well, they think it was all them. So they resent you as the investor, and they think you've made too much, because it's a people business. They're there every day, they have the relationships, the people work for them, they own the customers. You're the one that turns up once a month at the board meeting, and they will resent you. And then it becomes a bit of friction. So we have to know that we're both going to do well here. So we run the numbers to see, if we achieve what we think we're going to achieve, what will he make? And if we think he's not going to make enough, we would rather walk. Because as you know, these businesses suck up a lot of time to achieve what you want them to achieve. You're going to invest probably 5 years, and you don't want to have a fractious relationship because they think you're making more than they're making. So we need to understand, what is their position, what is their stake, how much have they got. So we, as a matter of principle, never buy 100% ever, because then we might as well run it. So typically the perfect 2/3, 1/3. So for me, management need to own a minimum of at least 1/3 of the equity. Not so in tech, they can own much less and it still works, but in professional services, it's got to be 25 to 33 is our kind of range.
Good.
I think this is quite an important slide. In any professional services business, when we invest in businesses, the biggest challenge most businesses have is their inability to attract talent. So how do you grow, a professional services firm? So I'll give you an example of one we did. So about 15 years ago, I was sitting there one Sunday reading the Sunday Times, and I saw that the government had just changed legislation on the legal business. So for the last 100 years, the only person who could own a law firm was a lawyer. 15 years ago, they changed it, and they said, actually, anyone can own a law firm. And I had this cynical view of law firms. I thought law firms by nature are technicians. To be a good lawyer, you're a good technician. Doesn't mean you're an entrepreneur, doesn't mean you're a particularly good businessman. Most law firms that I meet are boutiques. So I thought, actually, I think we can go in and we can buy a law firm, because one of their problems is they can't scale. So we acquired a firm called Knights, and this firm had been going for 250 years. So, you know, you were the client and your dad was the client and his father was, it's one of those kind of firms, and had about 30 lawyers, really sticky revenue, which is what we liked. So we took a 40% stake in the business, and one of the reasons we liked it was their biggest frustration was attracting talent. So to grow a law firm, you need to hire lawyers, but if you're not particularly good at attracting talent, you can't scale the business. Because of my recruitment background, I thought, I think I understand how to do that. So we took it from 30 lawyers to 100 lawyers, and we sold our stake back to management. They went out and fundraised, bought us out. We made 5.3 times our money, so we were quite happy. But they used our model and then raised further capital to grow, got it to 230 lawyers, and it's one of the few firms in the UK that's a public company as a law firm. So Knights now has gone public. I think it's got 550 lawyers. But the moral of that story was all about one subject: attracting talent. And it's interesting, something as simple as that, that was the only thing we did. Because we thought, we can't teach these people about law. They know everything you need to know about the law. We can't teach them about how to practice, how to charge. So we didn't interfere with anything. The only thing we went in every month was, what is our talent strategy? You know, last month we hired 7. This month we want to hire 10. How are we going to do that? What are we going to do? Who are we going to hire? Who are we going to target, etc.?
Was it also the question of leadership? Because what I hear, I used to own and manage doctors. Listen, doctors and lawyers are the worst kind of animals to to manage, right? So we had a problem of actually leadership. So if you find a leader and said, okay, you have a problem with talent, let's deal with that, right? But if there's no leadership, you cannot lead people.
In this business, I thought the guy was a good leader, actually. I thought he ran the business well. He was good at what he did. But I don't think, so for me, every entrepreneur I meet around the world, and I have this conversation, they all say the same, but James, it's really hard to find good people. That's the same all over the world. So I say, how important is that in your business? What do they say? Really important. If it's really important, how much of your time do you spend doing it? 5%? On a good day? There's the problem. Most people spend not enough time doing it. So I'm pretty good at it. Why? Because I spend 30% of my time doing it. That's the difference. Because I recognize how important it is. Because if it works, you can transform the business. That's how you grow the business. But can I be that good at it by only spending 5% of my time on something I've just said I think is really important? So every single person I've ever met in my life, the same thing has happened. They all tell me it is the most important thing I have to do, yet I only spend 5% of my time. So I say, if you were to spend 30% of your time, do you think you'd be better at it? Yes, I would. That's what you should do. Because I'm telling you, whatever else you are doing is not having the same impact as that would. So when I started Alexander Mann, one of the reasons Alexander Mann became so successful was I learned this one lesson very early on in my career and realized that to grow a professional services firm, whether you're running a hedge fund, financial services, legal, any business in that field, it's the same. As a founder, I thought my role was to go out and win as much work as I could, because that's what every founder believes in. But I thought, but there's only one of me. How much work can I really win? But if I was good at attracting other people to win the work, I could multiply that time and time again. So the penny dropped and I thought, I think I'm doing this wrong. I shouldn't be spending all my time winning the work. I need to spend more time finding people to win the work. Then I realized that actually it's quite difficult, because to find really good people, they're already working for good organizations. So if I wanted the best, why would he come and work for me when he already has a good job? And there are bigger brands. When most entrepreneurs start out, they don't have the biggest brands. So I realized, why do people join somebody? They join because you tell them a story. And people are not very good at telling that story. They're a bit clinical. Let me tell you, here's the job spec, and this is what you do, and this is your position, and this is your salary, da da da. That's not engaging. That person, when they come to you, they want to go home and tell their wife, oh my God, I met this guy, I met this firm, and you have to excite them. So I realized that one of the reasons we weren't was we were being a bit clinical. We didn't really have a story, and we weren't able to tell the story. So I wrote the story down and put some color on there, put some narratives around, built in my vision. Where's the company going? How's it going to get there? What's the journey? What role will he play in that journey? All of a sudden, the story had a beginning, a middle, and an ending, and it was exciting. Then I realized that people got really engaged with the story. Now I had something. Then, because the business wasn't particularly big and we didn't have a lot of money, could I outpay somebody? No, I couldn't. So I had to be really creative. And I realized that most people have got this obsession with equity that they don't want to give away equity. I remember speaking to my dad and said, like, I met this guy, I think this guy's amazing, I want to give him equity. And it was like I swore at him. We don't give away equity. Equity is houses, the family's business. I said, but Dad, this guy's amazing. I think he can transform the... Didn't care, just the concept of giving away equity. I said, but I don't get it, because if he's going to build the business, that means our smaller equity will be worth more than all of it. So I came up with a model where every significant employee I hired, I gave every single one of them equity in a formulaic way called a growth share. So whoever I hired, so if the business today, let's just make up numbers, it's done 5 million today, so I brought on a very senior person and I've said, you get a growth share and I'm going to give you 5% of the growth. So he gets nothing from the day he walked through the door, because that was there anyway, and whatever he grows it by, he gets 5%. At that time, what was the 5%? What did the 5% cost me?
Zero.
What was it worth? Zero. So I'm giving away 5% of nothing because I haven't got it anyway. But he was super excited because he owned 5% of what he was going to build. Then I realized that worked really well. So I then dissected the business into segments. So the next guy I brought in, he did financial services. So I created a financial services division and gave him 5% of the growth of the financial services business. The next guy did healthcare, so I gave him 5% of the healthcare. Then I hired a guy in IT, so I gave him 5% of the IT business, but it was all growth shares. So no physical value to me, but they all owned something that they were going to build, which they didn't have where they were. So I managed to attract people that really I shouldn't have attracted, but I gave them something that meant more to them than what they had. And that was just kind of thinking outside the box, being a bit creative, realizing I don't have the cash to say, I'll pay you more, I'm going to buy you, but let me give you something else. And this concept of the growth share just worked. And we built an incredible team on the back of that. I think just on that whole issue of selling the business, every time we've got engaged with somebody to buy a business from us, the first thing they ask for is, what is your 3-year plan? Everybody has a 3-year plan. Problem is, the smarter guys then ask you, can you show me your last 3 years and your budgets and your forecasts? And if you haven't delivered budgets on time before, the credibility of your 3-year forecast just went out the window. And we hadn't quite realised the impact, because of course everybody engages with a buyer and they produce their 3-year plan, not realising, and generally, let's be honest, it's a hockey stick, right? They all look the same. What they also have to understand, the smarter buyers do actually ask the other question, which is show me your deliverability over the previous 3 years and how accurately you achieve the business plans. And we realise that not many of them do, which obviously then puts you in a slightly awkward position because you now don't have the credibility of the 3-year plan, and your entire valuation was based on the business achieving the 3-year plan. If you now can't support it, somehow the valuation just dropped, probably by 30 to 40%. So we are absolutely obsessed with businesses we invest in, and we are very scientific on the budgets and the business plans we write because we recognise they underpin the value of what we're going to sell. And we don't just finger in the air. We are incredibly careful, plan it, understand it, track it, because we want to show, because let me tell you, when you can show the buyer, here is my 3-year plan, and by the way, here is the last 3 years' performance against plan, and we are 97%, 86%, 94%. We've now underpinned our future value, and we will get the multiple that we wanted. So some of those things we found have been incredibly valuable. End of subject. Any questions?
So from the line values that you show, it seems like they're mostly from commercial or financial DDs. Do you do any technical DD, anything that you look and value in technology that businesses use?
Absolutely. Because if we're investing, especially now, recruitment has been revolutionized with, different types of AI and technology, etc. So if we are going to invest, because of course the seller has increased his value on the back of that.
Yeah.
So if you're going to ask me to pay you an extra premium, I need to know the tech works.
Yeah.
So I will typically bring in an external person to evaluate the impact of that technology and whether it will enhance the value and the profitability and the margins, which is generally their argument, which in theory makes sense, but does it work in reality? I don't know. So I will pay somebody independently to come and assess that and give me an independent report that will verify whether that is correct or not.
I was interested to hear you say that how much you work with existing management. It's obviously stereotypically in PE, optimise costs, bring in new management, and particularly given your background, I'd have thought that one of your value adds is actually recruiting and bringing in new management. So I was wondering whether you could speak a bit more to that, potentially around the switching costs of bringing in new management versus working with existing management as an investor.
It's a great question. The problem in professional services, so if I acquire a business, generally speaking, that business is run by 1 or 2 founders. They are the glue that business was built on. They were the people that the rest of the people bought into. If you lose those founders, you have lost the glue and you've lost the vision. Those people did not buy into my vision. I'm not there every day. So if I have any fear that I have to go in and replace the management, I'm not going to do the deal. Because the chances are, if that I replace management, I will probably lose 50% of the rest of them. So the risk is way too high. So if there's any, so for example, when a founder says to me, we'd like to sell you the business and on completion we'd like to leave, we say we'd like to leave now because we're not going to do that deal because it's a people-based business.
So when you were initially hiring Alexander Mann, was there anything specific that you looked for in those early employees that you think is kind of what led to the success of the company?
Yeah, I think in the beginning, like later on, you tend to hire in very disciplined functions. You know, he's in finance, he's in marketing. I think in the beginning, you need a different type of individual because you don't have that institutionalized structure. So in the beginning, they had to be a bit more entrepreneurial. They had to think a bit more outside the box. They had to be a bit more multidisciplined because when we were smaller, you know, we kind of had to do everything. So 1 minute you could be doing marketing, next minute you could be doing selling. So what they look like in phase 1 is different to what they look like in phase 2. And to be honest, each phase thereafter, because you do become quite linear because actually, you know, 2 years before exit, it was quite structured then. They literally had to fit into a very narrow box because that was the discipline they had to deliver. But in the beginning, it wasn't those people. So actually understanding how the life of a business evolves and not everybody evolves with it. So what you hire in the beginning is quite different. They're a bit more nimble, a bit more entrepreneurial, a bit more think outside the box. The problem is those people are quite a nightmare to manage when you're here. They're actually not the people you want, but they were the perfect people in the beginning. So there is a difference.
Was there any special way that you were assessing in that entrepreneurial, those entrepreneurial sort of abilities that, you know, maybe you do uniquely?
I mean, I think when you interview them, you can see where they come from. You can see where they've been. You can see why they're leaving. And sometimes it's the why they're leaving that gives it away. Because sometimes they're getting away from, I'm in a box, I want more. So that was typically my kind of signs of why they left or why they want to leave and why do they want to engage with us. What do they think we're going to do that's different? And in the beginning, I think we were spending a lot more time assessing because it was quite critical then, and I wasn't in a hurry. And that's the other thing, I think, when I'm hiring talent, I'm never, ever, ever in a hurry because the consequence of getting it wrong is too high.
Your career's kind of been built on the recruitment side. Thinking back to those early days, why did you pick recruitment? Was that something that you were passionate about, or was it just, did you just spot the gap in the market and over time, building momentum, you just got more and more interested in recruitment?
I didn't really know what it was. If you want the absolute truth, I was 18, I saw a job advert in the newspaper and it said trainee interviewer, because in those days you had to interview candidates that you sent out for interviews. So I thought, when I saw the word interview, I thought it was a TV job. So I thought, yeah, it looks interesting. I think I'll go for that. So I went for the interview thinking I was applying for a job in TV. And then I turned up and it was an employment agency. And, you know, I'd spent the bus fare getting there. So I thought, now I'm here, I might as well go for the interview and see what it's about. But I just knew it wasn't for me because it was an employment agency. I didn't even know what an employment agency did. And anyway, I sat and I went through the interview, quite liked the guy, got on, and he said, look, I'd love to offer you the job. And at the time I was working in a shop as a sales assistant, working 6 days a week because I had to do Saturdays. I was earning £34 a week. This guy offered me 36, and it was 5 days a week. So I thought, oh, it's Saturday off, extra £2, I'll give it a shot. It was that strategic. And then when I actually tried it, I thought, I quite like this, because in the shop I had to stand up all day. Here I sat down, it was air conditioned, I had a desk and a phone, and it was a bit sophisticated, and it was fun.
And £2 more.
Sorry?
And £2 more, right?
And it got £2 more. That made a difference, because at the time my travel fare to get to work was £2, and it covered it. Changed my life.
I like what you said about management teams having to demonstrate how they track the forecast. But as an investor, interested in your thoughts on how you allow for the randomness that occurs when, you know, which impacts people's ability to get a forecast.
The question is?
The question is, how do you as an investor allow for that randomness when you're assessing the management team?
I think every one of them is different. I would love to say we have a cookie cutter. We don't. because each business is different, each individual is different, each sector is different. So I think we try and understand what are the specific components of that model, and when we make mistakes, it's because we don't understand it ourselves. So the key issue for us is to get as close as we can to understand the model, understand them, what works for them, what triggers them. We never get it right first time, ever. I think we always get it wrong. And then you tweak. But generally, we have a 3-year window. So our model is, in professional services, we're typically in for 5 years, on average. 3 years, the build period, 2 years is exit. So from year 4 and year 5, we are effectively grooming it for exit. So everything we've learned in years 1, 2, and 3, we now need to formulate, structure, in order to demonstrate value to the buyer. So we are that 24-month period where we're attending the monthly board meetings for 24 months. Every single month we have to get a bit closer. It's like dressing the bride. You know, put the earrings on, put the ring on, put the dress on. The bride has to be prepared, you know, for her big day. That's kind of how we look at it.
On that conversion to profit, revenue to profit conversion, I've got 2 questions. So first of all, if the margins are higher, is there any other instance apart from sustainability that would hurt you? And then on the flip side, if the margins are lower than the market, don't you see that as an opportunity to go into a company and increase those margins, since you know the business and know how to increase that?
I think there's always a reason. We've learned, you know, something's too good to be true. It normally is. So if the margins are too low, there's always a reason. There's something wrong. So in the beginning, I used to think like you. I think, oh, wow, he's only working on 12%. I can get this to 20%. You kind of naturally assume that because you think he's dumb. We've realized actually there's always another reason. Maybe the market's changed, or for example, we own a healthcare recruitment business where the customer is the NHS. So the whole business has one customer and they dictate the price. Nothing you can do. Doesn't matter how great you are, they have a set policy. We pay third-party suppliers X. So I made a massive mistake in that business because I didn't know that, because it wasn't a sector I understood. But I looked at the macro and I thought, wow, there's a great opportunity here. Anyway, we went in, we bought it, and we were in there for like a year, tried everything. But the problem is you can't change the price. So eventually we literally had to throw the baby out with the bathwater, because you can't deliver at the price they pay from the UK, because the cost base of the UK is just too high. So we've now built a delivery model in India. And so when we bought that business, it had 256 people in the UK. Today, it has 43 people in the UK and 296 in India. Now we can make money because the cost arbitrage between people over there versus here. But if I'd kept it to here, it wouldn't have made any money. Question?
If you were to start Alexander Mann with what you know today,
I wouldn't do it.
what different steps would you take from idea to execution to scaling to the exit?
It's a difficult question because the market has changed so much.
Yeah, but let's say what you know today back then. You were 18, but you have transplanted what you know today to that brand.
The truth is I wouldn't change anything, because I think that all of the mistakes I made were fundamental to my learning how to do it. If you avoid the mistakes, I don't think you can't do it, because I believe passionately that failure is a component of the journey of success. Without it, I don't think I would be successful, because I think we're all the same. When we get something wrong, we take it quite seriously. It kind of winds us up and we fight it and we learn. When we do something right, we take it in our stride. So if you're not going to make a mistake, how do you learn? And when I look back, all of the mistakes we learned shaped me, refocused me, and redirected me, because I learned that did not work. But if I hadn't have done those things, I'm not sure I would be standing here. So actually, I think that that whole learning, and I think as individuals, the one thing for me that I think has transformed the way I think is I absolutely embrace failure. I love it, I embrace it, I take it head on in. It doesn't faze me at all. Whereas I think when I started my career, I was afraid of it, I ran from it, I was embarrassed about it. But just that one change of mindset, that in recognizing that it is part of the journey. It's not an obstacle, it's how you get there. And I think once your mind accepts that, you kind of take it in a much more graceful way, and you learn. But when I look at my life, the only way I've ever learned is when I got something wrong. Otherwise, I'm not sure I reflect back on the things that I've done, but they are the things that always stand out. So, you know, even to this day, my investment in Benji's, the sandwich shop, was my greatest learning. It was amazing what I learned from that, because the reason why that business failed was we'd owned the business and we had 126 stores. And one day somebody called me and said, our store in Oxford Street, the landlord just put the rent up. I can't remember what the number was, but let's say it was paying 200 grand a year and the rent went to 400 grand a year. So I'm like, look at the numbers, and I think that doesn't work because we can't make an extra 200. So I go to the store and I take a seat and I sit in the store all day long, just watching people coming in, because I'm trying to see what can I do. And I realise that we are packed in the mornings, can't get anybody more in, lunchtimes is packed. So now I'm thinking, if I can't get more customers through the door, how do I increase the revenue? Because it doesn't have enough capacity. So I say to the manager, what is the most popular product we sell here? He said, a cheese sandwich. I said, okay, how much is a cheese sandwich? £1.23. I said, put it up to £1.45. So he did. The next week, the sale of cheese sandwiches fell off a cliff. I'm like, really? People won't buy for 20p. That was the mistake I made. I'm not a retailer. A retailer would know that consumers are very price sensitive. I then went to, believe it or not, because I had to make a decision about this business, so I went to a retail expert as a consultant, told him what happened, and he said, let me explain something to you, James. In the high street, there is a pecking order. There is a Benji's customer, who then evolves to a Pret customer, who then evolves to a Starbucks customer. They position brands, so she sets aside a certain amount of money every day for her lunch, and you are at the bottom end of the pecking order, and if you're now asking her to pay, she'd rather be a Pret customer. It's not about your 20p. She will pay the 20p, but not to you. Of course, I never thought of that. I just thought I need an extra revenue. That's why sometimes when you go into businesses you don't understand, something that basic, something that simple, I killed it. And I realized that I shouldn't be doing this, because these little things, you know, and of course in the mornings so one of the other factors, you know, because I'm smart, I took away, so we were making the sandwiches in the shop. So I thought, that's ridiculous. We should have a central station. So we should make it all in one place. It's cheaper, logistics, whatever, etc. So I spent a whole ton of money doing that. And then I messed it up because then the logistics of delivering, now I needed a whole army of vans every morning, 5 o'clock in the morning, delivering. The vans broke down, the drivers didn't turn. I mean, Jesus Christ, it just went. Whereas they were making them in the store, but for some reason I thought centralization would become more efficient, it would be easier to sell, but I killed it. So I kind of did 2 or 3 things disastrously wrong, and it just wiped me out. And I think the other thing I learned from there was when I realised that it wasn't for me, the best decision and the hardest decision was to say, I'm going to crystallise my loss. That was for me, if I look back on my career, that shaped my thinking, because in Dragon's Den, everyone who came through the door, one of the lessons I learned is we look at the business and we just know it's not going to work. So we literally explain to the entrepreneur, let me tell you why this doesn't work, give them all the reasons, and what do you think they said to us? I'm going to carry on, I'm not going to give up, because there's this thing about I should never give up. But the problem is, you should give up. There are circumstances in every venture where it doesn't make sense. But I think half the world believes, because they read a motivational book or a motivational quote, that whatever you do, don't give up. And literally, if there's something I could do, I would love to do something that educated entrepreneurs to understand that it's perfectly okay to know when to quit. And when I look at Benji's, if I had not have done that, because of the size of the business, it would have wiped me out. So the fact that I took it on the chin, accepted my failure, I'd got it wrong, it didn't work, I'm not the guy for this business, I'll crystallize the loss, which meant I didn't blow everything. So I had enough to come back and fight another day. But if I'd taken that conventional belief of don't give up, just keep going, what does that really mean? It means keep going until you run out of money. You're over.
Last question, I think, before we... Here's a bit of a different question.
Sure.
We're at a business school, and some of us are recent alumni, right?
Some of us have...
Are recent alumni of the business school, have done an MBA, and are looking to enter the job market again, right? You've been recruiting talent for many, many years, but the talent, the demand on the talent might change because of generative AI, technology, automatization of processes. Do you have any top advice for people like myself looking to
enter the workplace? Yeah.
Enter, but okay, I'll clarify. I've been a vice president of technology services in a global technology digital consultancy firm. I've worked in investment banking technology for many years. Now I'm finding the job market a bit difficult, so I'm building a portfolio career. I'm looking at different opportunities. Can I be an entrepreneur? Can I build something myself? Can I work for somebody? I thought, since you've been hiring for many, many years, that you might have some advice for us.
I mean, I think, to me, I think the first thing I'd say is, don't think of yourself entering the job market with a CV. Think of yourself as somebody who brings value to a business. What value do I bring to that business? What can I do for that business? I think conventionally we think, I'm going to write a CV and this is what I do, etc. And you position yourself like that. I think if you went at it differently and said, what is my actual skill set? What can I really do? How do I add value to that particular industry, business, or organization? And if you presented that to somebody, which basically means you can't just fire out CVs, you actually have to research the company. You have to understand what that business does, and you have to understand how can you make a difference to that business. So I've hired people in the past where I've had no vacancies. I've had no position, but somebody's approached me with not a CV, but a proposition that said, James, I'd like to come and talk to you because I've identified how I think I can add X. And of course, immediately I'm interested because clearly you've thought it through, clearly you've researched, otherwise how would you know what I'm doing that you can add value to? So I think it's a different kind of proposition, but I think people will listen because it's quite unusual. And because it's technology, it makes it a bit easier because you can see, especially right now where AI is just exploding, everybody's sitting there thinking, are we using it? Do we know how to embrace it? How do we bring it into our organization? So I think if you're entering the kind of corporate world, the question is, what value and how do I add value to that organization in the functional area of expertise that I bring?
Thank you so much. We're going to
We're going to carry on and continue the networking in the garden room right after this. But before that, I just wanted to sort of thank you, James, for your time. It's been a delightful evening where we've learned everything. I mean, what I've taken away is the amount of tenacity in your story, from the 11 months to the first deal, to the humility and sort of your collaborative nature, from giving people growth shares, from recognizing it's about the team and growing talent to you, and about having that narrative story to sort of draw and attract the right kinds of people. It's been a delight. I hope this is one of many more occasions that we'll get to host you. Again, please do carry on and continue the conversation downstairs in the garden room. But thank you.
Thank you.
so much.